Chapter 9, Multijurisdictional Taxes. One objective, describe the basic framework for international taxation. So let's start with introductory terminology for international tax models. Native country versus transaction country. Native country is where the taxpayer is a citizen or legal resident, or where the entity is incorporated or organized. The temporary resident or transaction country is where income is earned or transactions are completed. This sets up two potential tax scenarios, outbound or inbound. Outbound is the native country's taxation of citizen or entity's foreign source income. Inbound, temporary resident or transaction country taxation of foreign taxpayer earning income within its borders. Let's look at alternative international tax models. First, start with worldwide model. All income, regardless of source, is taxed by the taxpayer's native country. This taxes residents on their worldwide income. Taxes income of foreign subsidiaries regardless of whether the profits are repatriated to the parent company. All expenses used to generate foreign income are deductible. The foreign tax credit is allowed where the same income is taxed by other countries. Now contrast that with the territorial model. Only income that is earned within the country's borders is taxed by that country. Income earned outside the country by a resident or by a resident company's foreign subsidiaries is not taxed by that country. Deductions associated with foreign income are disallowed. There is an anti-abuse provision for certain types of portable income, and this deals with subpart F income, where this is deemed to exist. U.S. taxation is triggered as a constructive dividend. Now let's look at the blended international tax model in the United States. This blended international tax model taxes worldwide income of U.S. citizens, resident aliens, and domestic corporations. Non-U.S. residents' income is taxed on a territorial basis. This taxes income of foreign entities if they are connected with U.S. business. This model does not tax foreign income of U.S.-owned corporations incorporated abroad until the income is brought back to the United States. This creates the situation in which U.S. firms can indefinitely defer U.S. tax on its foreign income until it is repatriated. Tax planning with lower foreign country tax rates motivates a practice of no repatriation of earnings, and this creates a U.S. tax base erosion. This blended international tax model allows limited foreign tax credit for foreign taxes. This cannot exceed the amount of U.S. taxes that would be due on that income. Where foreign tax rates exceed the U.S. tax rate, the excess foreign taxes cannot be used as a foreign tax credit. Now let's turn our attention to transfer pricing. This is price setting process between subsidiaries of the same corporation who are related parties. The arm's length principle requires that prices for services rendered should be set as if the parties are not related, and in practice this may be hard to establish. To avoid risk of later challenge by the IRS, advanced planning agreements, APAs, are used. Companies with international intercompany transactions may enter into advanced pricing agreements with the IRS. These agreements establish a safe harbor transfer pricing method. And page 355 shows the GlaxoSmithKline Holdings case, which you need to review. Let's look at sourcing of income and deductions. Geographical source of income affects tax treatment in all international tax models. And I'll let you read through the narrative on this slide. And all of this is based on geographical source of income. Now let's move to sourcing of income and deductions. Income sourcing can impact deduction allocation. Deductions to be allocated were definitely related to income. Deductions apportioned where no direct relationship exists to income, and special apportionment rules for interest expense, research and experimentation cost, and losses on sales of real property. Let's finish up with tax treaties. These are bilateral agreements between two different countries regarding the tax treatment of residents. These are intended to mitigate double taxation. The Treasury Department negotiates U.S. treaties. The United States has tax treaties with more than 60 countries. Provisions can negotiate for reduced tax rates, reduced withholding rates, or exemption of certain types of income from taxation. Both the Internal Revenue Code and tax treaties govern tax treatment of international transactions. Where a tax provision in the Internal Revenue Code conflict, the one enacted later in time generally prevails. And this is a list of the U.S. tax treaty countries, and this is accessed through the textbook.